There's no restrictions on it. And we'd like to talk about the geopolitical and macroeconomic risks. They're pretty big at the moment. Just to say a few words before I introduce the panel, on the BBC's website, the Chancellor rowing back on the mini-budget, revoking almost all the measures, this is some news in just the last few minutes, that were in the mini-budget, is not the top story. The top story is Kiev attacked by kamikaze drones in Ukraine. So, in a way, that eloquently sums up the situation, the geopolitical situation, and to some extent emblematic of the economic situation, that the Chancellor has done something which would be unthinkable in normal times, to row back 3 weeks after a mini-budget on almost all the key measures. Questions over whether the government can stay in place, etc. But we are also in an extraordinary time now of inflation. And we're going to ask you a poll question in a bit, not just yet, about whether that makes gold more attractive or less attractive that we have the highest inflation in 40 years and rising interest rates. But what we want to do is focus on the risks here. And we have a panel of people who are very well placed to tell us about it. You've heard from Peter Zöllner, you've also heard from Isabella Kaminska. Saad Rahim is chief economist at Trafigura, which is one of the world's leading commodities trading and logistics firms, and can talk all about everything that's going wrong with supply of commodities, the price of commodities. And we can also talk to Adrian Ash, who's director of research at Bullion Vault, which is a fintech that helps retail investors and small investors get into the whole gold business and has a compendious knowledge going back through decades of the gold market. We're used to thinking of gold as a safe haven asset, and it's proven that in some of the biggest economic shocks we've had in the last few decades. I think it's accurate to say, Adrian will correct me if I'm wrong, that in 2008, when people really realized how bad things were, the gold price shot up. And it also shot up at the beginning of the pandemic, when people realized that we were in for the worst recession in 300 years, and all the death toll that we've been through. The gold price went up then too. But my understanding is that now it hasn't gone up quite so much. As we were hearing earlier, it's gone over a mountain, now it's coming back down. How does that reflect on the properties of gold as an asset, the fact that it doesn't pay an income, but that it is seen to hold its value? What about the comparison with the 1970s, the last time we had inflation like this, and gold was very popular? Why isn't it obtaining its popularity? These are all things to think about, questions to ask the panel about. I just want to say a quick word about the mini-budget, a little bit more. There was a couple of things that Kwasi Kwarteng and Liz Truss did that were very unconventional. One is that they didn't consult the cabinet on their key measures. Another is that they didn't consult the Office for Budget Responsibility, or rather, the Office for Budget Responsibility did a summary and left it on the Chancellor's desk in the Treasury, and he didn't want to know and he didn't want to publish it. And it was actually, according to the latest reports, the sending of that summary to Downing Street which made Liz Truss realise that things were actually quite bad and she'd have to get rid of her Chancellor. This is a situation where a Chancellor says, no, I don't want to see the independent forecasters' estimates of what my plans will do to the economy, which was one of the big things that discombobulated the bond markets and made them massively reprice the risk. It's from Machiavelli's The Prince, hundreds of years ago. Powerful people should surround themselves with people who are going to speak truth to power, not lickspittles who are going to tell them what they want to hear. That might also apply to the president of Russia, of course. But the other thing that I want us to think about is the fact that central banks, since the financial crisis, have been put in a position where they're trying to support the economy and generate more activity by super low interest rates, whereas the government was consolidating the public finances and trying to get into budget surplus. So monetary and fiscal policy were fighting each other, with central banks trying to stimulate and governments trying to consolidate. But now we have the reverse of that. It's flipped over. So you have monetary policy trying to tame inflation, government fiscal policy, very expansionary, putting more money into the economy and creating inflationary pressure. And it's that really caused interest rates to jack up in the UK, because the markets thought, well, they're going to have to put interest rates up to counter what the government's doing. And this doesn't do anything great for confidence, and I'm sure Peter will be able to put this in historic perspective. But it's also been a black swan, really, as Isabella was highlighting, that we didn't anticipate. And I'd like to really start with Adrian, actually, and just ask, to what extent does that sort of self-reinforcing consensus view of things create a blind spot, create something that we can't see, inflation coming over the horizon? And what's been the interaction between that and the gold market?
Well, Isabella's presentation this morning I thought was fascinating. When they come to write the history of the internet, social media, communities online, memes, hashtags, conspiracy theories in particular, fake news if you like, I think pretty much everybody in this room knows that gold and silver should have a starring role, because an awful lot of those communities began with conspiracy theories and rumors and anonymous blogs talking about the US Fed doesn't have the 8,000 tons of gold that it claims. That's an old idea. It's been around since they've had the 8,000 tons, right? But the communities that coalesced around that online, the red pill, blue pill thing from the Matrix that I've seen through what I'm being told in that case, you know, how much gold does the Fed actually have, what's really supporting the dollar? And then that morphed into, well, why isn't gold doing better? A regular complaint of a lot of gold bugs, right? Gold should be doing better. It should be doing better in the way I see the world. And the fact it isn't doesn't mean that my view of the world is wrong, which I think goes back to your point as well about blind spots. It should suggest that your view of the world is wrong, your model for how things work actually isn't, it's broken, and you need to look at it again. Instead, you say, well, someone must be suppressing the price then. And that will be central banks, and no offense, Peter, the BIS are involved, et cetera, and this conspiracy theory has been growing for years and years, and it's become very popular. And what we're seeing in our market now in particular, in silver, is this idea that there is a shortage of silver in the world, and this is reflected in premiums on coin. Everybody here that I've spoken to so far over the weekend, in the coin business, in distribution, logistics, everyone's at full capacity. They cannot mint enough coin to satisfy and deliver enough coin to satisfy retail investment demand for coin, in silver in particular, both in the US and in Germany. And we had a hashtag last year, hashtag silver squeeze, in late Jan, early Feb of 2021, which took the silver price from 25 to 30 bucks in a matter of days. It added, I'm going to say 3,000 tons to the SLV ETF in 2 days. This is a huge quantity of silver being pulled in, and of course, mints, small bar demand, absolutely exponential. And that hasn't backed off because the hashtags are still there. Okay, and this idea that silver is going to have its day in the sun. It did $3 a couple of weeks ago in a matter of days. Yes, it was short covering, but it's not short covering by banks, which is the meme, which is the conspiracy theory, that banks are short of silver. Banks aren't short of silver. Who might be short of silver is speculators betting against the price. We had a little short covering rally in what, across many other markets, of course, is relatively tight liquidity, or there's a lack of depth to actually, so you get big price moves. And we've had that in silver. So, from Isabella's presentation, what I think is interesting, talking about social media and hashtags and trends, what's the actual real world outcome of those things? They're not just ideas. People's behavior changes. We see it in our market. We see people buying bar and coin and hoarding them at home. And there's a strong political affiliation with this as well. Gold, I think, is always a political investment. To buy gold is a political choice. It's a bit of a statement.
And a rejection of governments, a sign of lack of trust.
Absolutely.
In governments.
It's to say that even with some small portion of my reserves or my portfolio or my fund, even some small portion of it, I'm going to park that so that I don't need to trust my counterparties. I don't need to trust the credibility of an issuer or a sovereign who's going to repay the debt. And John Maynard Keynes famously called gold a barbarous relic. He's talking about the gold standard, but gold itself as a barbarous relic, I think, is an interesting idea. It does take us back to a time, and again, this is one of the social media memes, right? This is preppers, this is people getting ready for the end of the world kind of stuff. Our market does very nicely out of that, even though we're not driving this. It is actually a grassroots thing that people are discussing this online in communities, Twitter, Reddit in particular, very short, urging people to buy silver is going to the moon.
So that has to bump up against the concrete reality of supply and demand at points, doesn't it? Even if you hype an asset and try to get people interested for various reasons, ultimately if the supply of that commodity is disrupted or frustrated because we're hitting capacity, then it has its effect on the price regardless of the hype.
Well, yes and no. I think this year what we've seen over summer has been what I would say across commodity markets. And for those of you who don't know, Traffic Bureau, we're one of the world's largest both oil and base metals traders, and also gas and LNG. But what we have seen over and over again this year is what I would say the immovable object of what is happening in fundamentals, micro markets, versus the irresistible force of what's happening with the macro headwinds. And so you look across various commodities and you say, well, prices are falling because people are worried about the Fed and other central banks hiking rates. You're worried about the European energy crisis. You're worried about China property and zero COVID. And so flat prices will be falling, and yet at the same time, premiums, ARBs, everything are going, those are going up and are telling you that that physical market is ever tighter. And your backwardation in some of these markets has gotten extreme. And so you're saying, well, okay, our supply-demand fundamentals are suggesting prices should be going higher, and yet we're not, because we can't see straight for this. And I think what we've seen this year has been a lot of the large macro funds came in Jan 1 and said, the trade this year is long dollar, long yields. And don't talk to me about anything else. In fact, some of the funds that we've talked to have said we could be out of copper or zinc or gas oil. I don't care. I've got the dollar yield trade on, which has worked very well for a lot of these people, right? But I do wonder if coming into next year, right, that trade is, if not done, then at least limited upside. And once people come in, clean P&L, and say, all right, let me look around, what's the next trade? And you go, well, we don't have enough of these things. And part of the problem I have across a lot of these asset classes, or these commodities, I should say, is if you weren't investing, for example, in oil, if you weren't investing this year at 100 to 120, and when rates were lower, at least in the first half of the year, you're not investing when it's 80 to 100 and rates are much, much higher. So I think we end up in a position where we look, we were talking about this around central bank inflation forecasts, right? And how you just roll down basis the forward curve. If you were to look at all these markets, you go, well, since we're backwardated, inflation should just sequentially start to come down. And instead, I worry that you end up in a situation next Q2 where China is maybe reopening mRNA vaccine, US, the Fed is maybe at least on hold, you're going into summer driving season. Europe at least is not winter, and people go around, okay, well, I need 2 to 3 million barrels a day more of oil. I need X 100,000 tons of copper. We don't have it, and all of a sudden prices, instead of rolling down, are starting to go back up, at least for this side of things. And that puts us in a very different world again, at least in terms of where people are projecting interest rates, everything else to go, right? And if gold in particular then has been an interest rate story over the last little bit, we were saying, it struggled to perform in what should be laboratory conditions given how much inflation and geopolitical uncertainty there is. And if it's not, it's because of what's happening on rates. So again, when I look out next year, instead of this nice sort of curve where everyone's rate projections, including the Fed, start to come off by the end of the year, are you at least maybe on hold, or maybe even having to think about going higher again, right?
Okay.
And that is a world I don't think people are really kind of thinking about.
Okay, thank you very much. And we've got a question coming in. Do put your questions on the chat. We'd love to hear from you, anything you want to ask. But maybe I can throw this one to both Isabella and Peter. What were the high inflation indicators that we were missing, or what data should we have paid more attention to? What was our blind spot, if you like, Isabella, in the run-up to realizing how bad inflation was?
I mean, for me, it was just the obvious consequences of lockdown policy and the fact that supply side would be constrained. Early indicators were obviously the semiconductor issues that were coming out in terms of bottlenecks. There was the difficulty in rehiring staff coming back from furlough in, I don't know, all the respective programs in Europe. But also I think another really important one was the huge engagement by people on furlough in, say, stock market trading. We had that whole phenomenon of, the stimmy check in the US, and to what degree, people were riding on the highs of temporary stock market gains. I think that was also an interesting indicator, because what goes up has to come down, and people were pulled out of the workforce because of that amazing, windfall that they'd got, and now are very difficult to woo back in. So I think those were the early indicators for me that something paradigm shifting was going on. And the last one, I think, also, for me, it was all on the labor side. I think the lying flat phenomenon, where people were de facto kind of no longer engaging in work as they used to, or silently sort of protesting work and doing the minimal they can. So that would have had an immediate impact on productivity.
Peter, I mean, the Bank of England, for example, recently admitted that it failed to foresee that there would be so many workers who wouldn't return to the workplace after the pandemic, which is still as yet unquantified effect of long COVID, among other things. What other things do you think were missed by central banks in the run-up? Because clearly they weren't anticipating it, they were all saying it would be transitory.
Indeed, I think that the first quarters after the pandemic hit in early 2020, there was quite a big consensus between both central bank economists and also private economists, banking economists, that there is a most likely outcome would be sharp drop in GDP, and as we saw on the chart, also a drop in the inflation rate from already low inflation rates. There was a discussion about deflationary effects.
It's easy to forget, sorry to interrupt
Yes, so
that oil prices turned negative, for example.
If we put ourselves back 3 years, most of us here would have said, well, they don't even reach 2%, and if something like that, GDP minus 8%, minus 6% in major economies, that could lead to a deflationary sort of development. And that was a time when globally, practically all central banks did the same. They supported liquidity, supported markets, stepped up purchases, and lowered interest rates. Now, the changing point probably was about 1 year after the pandemic lasted and had a few waves. Nobody really knew what will the next winter bring. It's always easy to judge from 3 years later. And I think there was a point when some inflationary figures came out, in particular in the goods industry. For goods, less so in the services, because there was a rotation of consumer behavior more towards goods, where there were shortages, delivery chain issues. I wanted to buy a refrigerator. took me 6 months to get one. This type of thing, many of us had experienced. But at that time, I think there were signs that the pandemic, lower participation rate in the labor markets, big support by governments for hardships in both for private households, but also for businesses, is sort of covering up a bit the real situation. And still, a year back, most people thought, and I picked up a few charts, many people in the industry told me, well, that was a year ago. Inflation will peak in early 22, and in central banks, the US Fed was expected to raise rates 4 times 25 basis points during this year. The big change of the picture came in at the end of December of last year, when the Fed indicated things have changed.
Notably before the Ukraine invasion.
Yes, before I think the Ukraine invasion just added another big layer of a more permanent, entrenched inflationary picture, because suddenly it was not seen as transitionary. It was not seen as, let's say, trade unions will not ask for 6-8% wage rises. That came during the first part of this year. And I think that changed the picture and led the central banks to do what obviously is necessary.
Can I just
Isabella?
add to that, because it is one of the points that I forgot to mention. See, I disagree slightly. Because in 2021, in around, I think it was October, we already, and I think, Sad, you might remember better than me, nat gas prices were already going up, right? So we already had a very clear indicator that there was something really unique going on in the energy markets. And I think the big blind spot at that point was the idea that Putin wouldn't take advantage of our clearly distressed supply and demand situation in Europe, because it was self-evident at that point, for reasons not connected to Putin, that net zero had driven us to a position where we were finding ourselves with a deficit that we were facing. And it seems obvious to me, if I was a politician that was keen to do whatever Putin's doing, that seemed an obvious vulnerability point. And I was actually at that point predicting that if we don't see some sort of hostile action from Putin between then and January, February, I would be very surprised. And it seemed clear to me February would be the moment he would move, because that is the traditional moment where everything is destocked and Europe is most vulnerable.
Well, look, I think 2 points to pick up on that. One is what I think we were missing was really, since 2008 up until 2020, massive underinvestment across supply chains, and in particular in commodities, right? And so for us, yes, coming into this year, we were looking at oil markets, for example, going, this is already an incredibly fragile system. There is no slack in this system, and all it's going to take is one sharp hammer blow, which is what the invasion was. But it's writ large across everything, right? Is globalization, in a sense, was, okay, let's outsource these supply chains, in particular China, but everywhere else. So when you disrupted that...
Putin doesn't appreciate your commentary. Hack.
But the point was, with that little slack in the system, you were then saying, okay, we have no room to adjust. And then beyond that, I think the other thing that people miss, and this is something when I said internally, I've got a lot of pushback, but I said, throughout history, whenever you've had a pandemic, labor's relationship to work has changed. Now, normally it's because a third of Europe has died, and we didn't have that this time, thankfully. But you saw it in the quits rate. You saw it in also the number of applications for small businesses, for new businesses being created, tripled in the U.S.
Yes.
Right? So it wasn't just that people said, all right, let me leave.
You're having a mic.
This was literally a
adjusted
cyber attack going on.
So it wasn't just that people were quitting work, but they were saying, okay, I want to do something different. I don't want to stack boxes in a warehouse, night shift in Walmart. Let me go try and do something else. And so I think that's one of the things that people missed, was how much of that impact would have on the labor force.
We've got loads of questions coming in, so thank you very much. Amazing efficiency. I think a round of applause for the audio-visual people sorting it out. When do you expect unemployment rates to start rising significantly? Peter?
Well, we know from history that there is a time lag between the first monetary policy tightening and an effect on labor markets and other markets. So usually it has been more than 6 months that an effect happens, but probably I can join what my colleague here at the panel is saying. Currently it's quite unprecedented what's happening in the labor markets. We don't know how far we can back to a pre-pandemic situation. People tell me the labor market is one of the markets which has structurally changed the most. Participation rates have fallen. People are looking to do new things, other things. Legal immigration is relatively low, and mobility, therefore, is not as high as it was before. So I think we don't know yet, but my best guess would be that it's again different from jurisdiction to jurisdiction. There are countries or economies where the labor market will be more resilient, but it's still very, I would say, surprising that most labor markets, even in countries where the energy crisis is hitting hard, are still very resilient. So I would not dare to make a forecast in terms of months, but I would be expecting that in the first part of the next year, there should be an expectation of some weakening in the labor markets.
Thank you. One for Saad, I think, and also Adrian. Does the energy crisis raise geopolitical risks, such as resource nationalism and subsequent disruption of key raw materials? If any commodity is regarded as global, it's surely gold. But could that and other commodities be subject to new forces of deglobalization, nationalism?
Well, I mean, certainly for gold, precious metals more broadly, we've already seen this with Russia, because the Western response has been, whilst we continue to burn Russian gas and oil for the time being, to say no. LBMA was a leader on this, to say, okay, Russian refiners are being suspended and taken off the good delivery list. Their metal is not acceptable in London. LPPM has done the same for platinum, and particularly palladium. This really matters. 40% of palladium production comes from Russia. So the palladium market has been in stress for many years because the move away from diesel in Europe towards gasoline engines. You need palladium for this primarily. And so, that market has regularly, the LPPM needs to be applauded, and its members, for actually managing to get through the supply problems they were having in palladium before the pandemic. The tightness there doesn't seem to have been as sharp as it was previously. Everyone's best guess is that the palladium from Russia is coming out and it's going via China. And I think this, in terms of geopolitics, it's not maybe so much about nationalism as the real risk as new blocks forming. Yeah. And particularly Russia and China. Now, I'm not a Beijingologist on this, but my sense is that Beijing is not particularly happy with Russia doing what it's doing. Okay, this really rocks the boat, right? More than Beijing would like the boat to be rocked. But the idea that actually, and obviously there's the Shanghai Cooperation Organization, the SCO, moving towards, let's do more bilateral trade outside of dollars. This goes back maybe to some of the conspiracy memes. The dollar is doomed. Yeah, the dollar's at 20-year highs. I mean, it's that echo chamber on the internet of, the dollar is doomed, You've got to get out of dollars. Well, that's the worst advice you could have had over the last 2 years.
Because of the flight to safety.
Because of the flight to safety.
Yeah.
And let's face it, in a dash to cash is still dollars globally.
Yes.
That's what it means. But I think what we are seeing is definitely the idea that actually, and again, because of sanctions, I think what we have, particularly for Western polities, to say, we don't like your behavior as a sovereign, we don't like your behavior as a state, and therefore we're going to shut you out of financial markets, we're going to shut you out of accessing your reserve assets in some case. Case in point for our market, of course, is the Venezuelan gold at the Bank of England. That court case is still going on. My understanding is the UK commercial court last week overturned I think it was the same judge, overturned her own previous decision to say that Venezuela could not continue an appeal about trying to get that gold released from the Bank of England for the Maduro regime.
Right.
And of course the bank has to operate under British policy, and that recognizes Guaido as the de facto president. But it does look as if US attitudes towards Venezuela are thawing, and that of course comes back to energy policy and availability again. And so it's these tensions here of, well, we can lock you out of certain markets. You might respond by creating your own. You might respond by doing your bilateral trade with other bad actors, as far as the West is concerned. Well, fine, we'll go and do it between ourselves then.
So do you see that happening? I mean, you keep an eye on these trade flows all the time, don't you? Is it trying to impose sanctions on a state like Russia to do with a commodity like gold is very difficult, isn't it? Because there's the commercial imperative is pulling in the other direction, and good actors may observe sanctions, bad actors will undermine them.
No, I think that's right, and I think we're, as you say, already seeing that. And I think your point about new commodity blocks is absolutely right. It's one I've made a few times as well. It's because we've gone from a world where Europe and Russia were so entwined that it was hard to envision that separation. But now that train has left the station, at least as far as energy is concerned, right? So now you have a world where you can see Europe coming into at least the U.S. energy orbit. The U.S. has been one of the beneficiaries of this. If you look at oil, LNG, all of that coming out, and saying, okay, well, we start to move that way. And you have Russia, Iran, India, China saying, okay, well, we maybe then form a new commodity block on the other side of the world, right? And yeah, I think absolutely what we've seen is, time and time again, is sanctions are a very blunt instrument. They are very hard to enforce globally, unless when the U.S. resorts to the sort of the nuclear option of using the dollar, right, and weaponizing the dollar. When it's simply things like what we're seeing around Europe, energy sanctions, price cap, without the secondary sanctions, and all you're doing really is redirecting rather than reducing, right?
There's these ironies throughout this episode, aren't there? That, for example, Putin's war has benefited the dollar a great deal, and that there are all kinds of little ironies like that. Isabella, I wonder what the next blind spot or black swan is. People are talking now, the story that we're all hearing, the story we're all buying into, and therefore the consensus, not the blind spot, is we've got bad inflation now, there's a flight to safety, etc. What if that's going to reverse? Because, for example, energy prices, the oil price is not that much higher than it was before the invasion of Ukraine. Wholesale gas prices hit a peak and then have come off since then. Is it possible that we may be underestimating the risk of deflation? And I know that sounds ridiculous at the moment, but think back to 2013, 2014, when all the shale oil came on stream. In 2011, we were saying the same story as now. It's the aftermath of a big crisis. We were saying, what's happening to the price of fuel? What's happening to the cost of living? 3 years later, so much more fuel had come on stream that we were at risk of deflation.
I mean, they say there is no better cure for high prices than high prices, right? And usually there's a lot of logic to that. But I think the idea that we're going to be facing a deflationary period is fairly consensus. I think that is the expectation in the markets right now, rather than being a blind spot. And I actually don't think that's the case, because I think there are certain bottlenecks this time round. That means that old adage about high prices being the best cure for high prices is not going to work out, because we're facing headwinds that are related to ESG and other real kind of financing issues, amongst them the increasing politicization of the dollar. Everyone's sort of...
What do you mean by that?
So I think this is one of the big blind spots, actually. It's this idea that, obviously the dollar has been a beneficiary. The fact that the dollar is super strong is not necessarily a good thing for the US, actually. Secondly, there is a tension and conflict now between laissez-faire kind of solutions to the... So look at the UK. So Jeremy Hunt has basically backed down on every political decision that Truss took because the bond market had a wobble. So on one hand, that is an example of politics being hijacked by the markets, and the markets basically being in charge of stuff and not politics. Politics is basically not in charge. So we're creating this perception the markets are in charge. But in reality, I think in the next few months or whatever, it'll become clear that politics is going to fight back in a major way, because the bond markets are not going to be able to absorb the absolute sort of panic and chaos that emerges from the regime they want to impose on the UK and on Europe. So the politicization of the dollar is the fact that the dollar is no longer really a neutral currency. And one of the reasons the dollar has become a reserve currency in the first place is because historically, despite the Cold War and despite whatever export-import sort of controls we did have, by and large, the presence of a physical currency dollar in circulating through the USSR or wherever, it was a neutral currency. So my father actually worked in remittances. He used to do sterling payments from the UK to Poland during the Cold War. And he would tell me, that was the beauty, back in Poland in those days, if you had dollars, you were king. And by and large, nobody really cared that the USSR communists were operating in dollars, because that was the way we were taking down that system. Dollar neutrality was the way free markets would penetrate into command economy structures and bring them down. Now we're doing the exact opposite. We are basically applying capital control mentality, and we are politicizing the dollar. And that is going to create an opportunity for a new neutral entity to financing tool, whether it's Bitcoin or whether it's gold. I'm not sure. I mean, interesting about the Venezuela case, because I didn't know about it. But if that's the case, then I think gold might also be being politicized. I don't know enough about it.
It's always a political asset. It's always a political asset.
Right. So there is no true neutral asset, and I think money needs to be neutral to be able to do price discovery between these different political blocks. And at the moment, back in the day, that used to be the dollar. That is no longer going to be the case, and that's what I mean. I think that's the blind spot that we are facing, is how markets will adjust to the lack of a neutral financing intermediation point.
I want to come to you, Peter. You've got some thoughts already, I can see, but I also just wanted to ask you, because we've got a question here about how this all affects emerging markets. How do you believe emerging markets are positioned to weather a downturn in global demand, higher borrowing costs, and the bit that's not there, a stronger dollar, which is very hard for a lot of emerging economies?
This indeed is something I would like to follow up on Isabella's comments. The role of the dollar and the strength of the dollar for different peer groups of countries. And if you look at the emerging market economies, which by themselves are not one peer group, but very much differentiated, you would have expected that this strong run of the US dollar and the very fast interest rate increases, which were unexpected a year ago, would lead to more tensions with emerging market countries and economies, and actually they coped quite well, most of them. There are some bigger emerging economies with the idiosyncratic problems, but overall, if we look at the emerging market as a group, they have coped pretty well with the strong volatilities in market. That is probably because the exchange rate policy functions to some extent. We have seen quite a weakening of some Asian currencies. Latin America, probably given the structure as commodity producers in some cases, probably did relatively better to some extent. And the exchange rates were a bit more stable, let's say, in countries like Mexico. But overall, I would say you would have expected more troubles from foreign exchange denominated liabilities in some cases, or from the terms of trade situation. Overall, they are handling the situation pretty well.
Okay, thank you. I want
and one word probably, because just last week there was the IMF World Bank meetings, and a lot of discussions, of course, were certainly around currency volatility. And if we filter out the US dollar from the gold price discussions, gold isn't that bad if you express it in other currencies. So you really have to look a bit from a viewpoint of your own situation. But certainly the appetite is what I saw coming out of Washington. Appetite for concerted intervention seems to be very limited at this point of time. So this dollar strength is certainly not easy for some countries, but at this point of time, I think especially emerging market countries are handling it quite well.
Just following up on that, there's a question for you here, Adrian, but I just want you to think, I'm going to poll you in a second as to whether you think in this era of high inflation, gold has become more attractive or less attractive. But Adrian, there's one here. Gold's looking like the dog that didn't bark, and I think this just refers to what Peter was just saying. The context would suggest, wouldn't it, you would have thought that gold would be doing very well. Central banks can't coordinate, there's a war, there's inflation. Why isn't it doing so well?
Because you've got the wrong model again, right? It's about saying gold should have done this, and it hasn't done that. So you actually need to say, well, then gold shouldn't have done that, because that's not how it works. The big curveball for that, absolutely, you have inflation at 40-year highs. You have geopolitical stress like we haven't seen for, frankly, in my lifetime, I don't think. But what is it that's pushing against gold? It's rising interest rates. Now, inflation, people assume is good for gold. The case for gold as an inflation hedge is intuitive. It's very basic. Throughout all human history, gold is the ultimate prize, all cultures, all ages, the ultimate store of value, everywhere, every culture it's ever been discovered. And so there's a natural sense everybody has that gold is a great inflation hedge. Then, of course, there's all the research that says that over the very long term, by which time we're all dead, yes, it gets back with inflation, right? The cost of living, fine. But I'll be dead, potentially. Shorter term, i.e. within my lifetime, no, it's not a very good inflation hedge because there's no actual relationship between inflation rates and the gold price. There simply isn't one. I mean, for anybody who hasn't read The Alchemist yet, the new edition, which is out for the conference, you've got to read Jim Steele's article about inflation data versus gold prices. There is no relationship you can hang a hat on.
It doesn't go up when inflation goes up.
What matters is interest rates and inflation. It's about what happens to real rates for gold, both across longer periods and also shorter term as well. I mean, this is how it's traded now, very much off 10-year treasury, inflation-protected treasuries, TIPS. Traders, their algos, they're looking at the TIPS yield. What does that do to the gold price? Quite literally in real time. But longer term, it's very much the direction of real rates, because if I'm getting a rising return on cash, even if it's still negative, and this is what a lot of people I think miss, cash rates across the world, bond yields across the world are deeply negative. I think in the US, Germany has never had interest rates this negative in real terms since literally immediately after the war. You know, we're talking about negative 10% on cash.
And the contrast with gold is then less, because gold, of course, doesn't pay an income.
Absolutely, but that rate is moving upwards, even though it's still deeply negative. If you look at the States, you're still 5% underwater on headline CPI at 3.25 from the Fed, but it's moving in that direction. And if inflation doesn't continue to rise, then you will be squeezed. So I think, you know, the outlook for gold, what's supporting gold against that? I mean, I would turn the question around, to be honest, Andy. You know, why hasn't gold dumped on rising interest rates? It's what happened in 2013, as we all remember with the winds here. Okay, gold lost 25% in a matter of weeks because the taper tantrum, the Fed were going to raise. By the time the Fed did raise at the end of 2015, it was actually the day that gold bottomed at 1045. So gold is very sensitive to interest rate expectations, and real rate expectations in particular.
Let's canvass some views here. Now, we have this polling facility. You can hopefully see it on your app. If you could all have a look at your app, and you should be able to see the question there, which is, do you think the highest inflation in 40 years and rising interest rates make gold more attractive as an investment or less? So just vote A, more, or B, less. We like your views. You're the guys who know about this. While we're doing that, can I just ask the panel, what's your view, more or less?
Well, I think real interest rates, it was a very important factor for shorter-term gold price moves. In the long run, I would assume that retail, coin, jewelry, but more coin business is here to stay, and there will be opportunities to buy gold, and they do not sell the gold once the gold goes up. I think there is another group of investors which has become, of course, dominant in some episodes. It's the institutional investors, it's the hedge funds. And they might completely act differently from what the retail is doing. And they are going in and out. But the basic holdings of gold with owners who are strong holders, strong hand, central banks, retail, I think this is an opportunity for them to add gold to their portfolios. And I don't have enough insight on the short-term moves by hedge funds and institutional investors. That might be an overlay which really disrupts sort of a more stable development in the gold price. This leads to the volatility.
You can see the results up there, of course. You'll have seen them long before. Our guests have more is the consensus view. Sud, what do you think? Is the consensus right in the audience?
Go on.
Sorry.
No, go on.
I wasn't sure. Yes.
No.
Yes.
Sorry, Isabella, you go ahead.
I mean, I'm actually, I'm very neutral on this because I think I feel like I should push back and be a contrarian, but at the same time, I studied ancient history, so over the grand scheme of things, it really depends on the duration that we're talking about. And since I think we're moving into more of a war economy with politics coming back very significantly into the fray, and the whole kind of great moderation stroke, laissez-faire system coming potentially to an end, I'm going to say more, mainly because my grandparents Polish and smuggled out their own gold, and it's still got it in my house, and it seems to have kept its value.
Sud?
I was going to say, are there other places that I might say, or other asset classes I think would perform better? I think yes, but I do think and one of the questions that we had, that maybe we'll address it after this, but is this question of, are we in a commodity super cycle, or as I would actually call it, maybe commodity super spikes? And that creates a lot more volatility and maybe creates the blind spot everyone has is eventually inflation will start to come back down and normalize. Well, what if it doesn't? And in that case, you can't continue hiking rates, but maybe you do hold them, and so that the direction of travel on real interest rates at least starts to slow down, but that's still a high inflation environment. Maybe that's somewhere where then you say, okay, there is a bit of a relinking now. And in that case, I would say, yeah, that's a more attractive environment.
I mean, I think the question is very nicely put, because I think it makes gold more attractive, but that doesn't necessarily mean the price will perform very, very strongly. Talking with a good friend from Germany last night, he said he's very active in the coin market there as distributor, and he said, for a lot of German households buying coin right now, price is just not a consideration. It's about having the gold. It's about having the coin. It's about having it at home or having it in the bank deposit box or whatever. So I think absolutely, all the stuff which is supporting gold is the inflation. It is the macro. It is the geopolitical strife. And, net, will that win out against a rise in real rates? Price-wise, I don't know. I mean, often price is the least interesting thing in our market.
Peter?
I wanted to raise one other aspect which has been discussed in former conferences from time to time. It's the cost of production of gold, because the marginal production cost might also be a factor of how the gold price might be in the medium term might be affected. I remember a conference by LBMA in Johannesburg, maybe 15 years ago, and on a Friday we were invited to go down to a gold mine. And actually we suffered and we experienced a seismic during that excursion. Gold was at around $460 per ounce at the time. And I remember, and I see a few colleagues from the central bank community, when we came out of that experience, everybody of us said, look, $460 per ounce to produce gold is much too cheap. Just an intuition, not based on risk return considerations. And I said to a few of my colleagues at the time, gold should be at least 1,000 if I see the conditions, how you produce 1 ounce of gold. And many of the investors have never seen a gold mine. This was my first time at the time too. Now, if I see efforts to make the gold production and in general production more sustainable, the cost will go up. So the marginal cost of producing an ounce of gold, would be my best sort of expectation, will have to go up. And therefore, I would also expect that this component might support the gold price looking ahead, not the next year and not the year after, but maybe 2030, 2035.
Let's talk a bit more about geopolitical risks, and specifically Africa. I did a documentary where gold was coming out of Africa and going via Dubai through a firm called Colotti, and also money that had come from the sales of illicit drugs in Western Europe was also going to Dubai. Cash was buying gold, scrap gold, and it was taken to Dubai. They'd get cash back, and then it would be cleaned. I know a lot of the industry steers well clear of this, but obviously there are high rewards for those who are willing to engage in that kind of illicit activity. Do you think good progress has been made in the last, well, since Dodd-Frank, for example, in trying to crack down on that? And does that add to the cost of production? Does that add to the overall costs?
Well, I wouldn't say if a criminal background is, let's say, the basis of a gold transaction or precious metal transaction. I would not count that as, this is a governance issue. It's an issue for tax authorities to break down those practices, those bad practices. It's an issue of other governance bodies to make sure that certain locations in the world are free from criminal energy when it comes to our markets. This is not only true for precious metals, this should be true for every asset. I consider sustainability to use a more sustainable way, use methods to produce gold so that the environment is protected, that we protect the social standards. And we know that in our industry, in the gold industry, there are still certain countries where the standards are not up to date. We observe, and this is one of our jobs at the BS, and I'm speaking under the control of Benoit Gilson, who is our head of gold and FX. We get approached from a number of central banks regularly to support them in their gold operations. We have seen a few, and I think this in general is a good trend to improve the governance, that central banks take an active role in cleaning up the practices in their domestic gold markets by purchasing gold directly and making sure that the standards under which the gold is produced is respecting human rights, is respecting labor standards, is respecting environmental issues. Now, this is something we as central banks can do, and I think this is very important also for the end purchaser of the metal.
Obviously, if you impose higher standards, it's one thing, but if that just means excluding a bunch of countries so they can't export gold, as we were hearing from Ruth earlier, it doesn't really necessarily help those countries. How do you reach a point, question to all the panelists, of satisfying gold investors, from everyone from Apple to central banks, that they're not sponsoring war or child labor, and not excluding countries like the Congo from exporting one of their most lucrative commodities?
Well, I mean, the work that the LBMA does, obviously the London Good Delivery Standards, all of that stuff is really addressing that, and has been now for 10 years. I think it was 2012 that the responsible sourcing first came in, obviously, and that makes the pinch point the refineries to basically know where the supply is coming from. I think, of course, it increases the cost of production. This is a point which many refiners make to me on a regular basis, right? They have to do more audit trails and so on to demonstrate what they were already doing. I mean, I think there was a certain perception, perhaps pre-2012, that, oh, the gold industry needs cleaning up. Well, these things were already being done, but it is about demonstrating that. I think the key issue is, as Ruth mentioned this morning, and as we're going to be hearing tomorrow, in tomorrow morning's session, is about trying to formalize and enable the legal mining and sale of artisanal small-scale gold. Because there's, I forget the number now, Metals Focus can shout out for me, but how much of the world's gold production do we think is ASM now? I mean, it's a chunk. It's a big chunk. 20% perhaps, 15% annually is coming from, effectively, people scrabbling in the earth to get the gold out. Some of these mines are much more industrial scale and so on. So how do we get that gold into the supply chain? Of course, just going back to the point about social media, the LBMA tweeted out this morning about its ASM initiative to try and help formalize and legalize some of these supply chains, and the immediate response on Twitter was, oh my God, they must be running out of gold if they've got to get it from panhandlers. Okay? That's literally the first reaction on Twitter.
So,
I mean, look, not so much from the gold side, but I think for another commodity that we have experience with is cobalt is very similar, right? And saying, okay, does it come from ASM, and how do you deal with that? And so we created a partnership that then invested quite heavily to say, okay, how do we then realize that this is the reality on the ground, that this is what's happening? So how do we then ensure that we can put in place not just safeguards, but also then to create what is a sustainable livelihood practice for people who are involved in this, right? Because just saying, okay, well, we won't do that, or just shutting it down doesn't work either, right? And so there's a balance to be there. But like we've talked a little bit about across all of these things, including on the gold mining, you said look at the cost, it's too low here. I think that's similar, right? Is we're not fully pricing this across so many of these commodities, right? Is that there needs to be investment if we are to then put in place the types of standards and practices that we want. And I think that's still being underpriced right now.
Isabella?
I mean, I'm not an expert in this field, but it does. The point that comes to my mind is that this is very similar to sort of the pressures. The sensitivity with dealing with cash crop farmers who turn to growing, poppies or some other contraband, right? So they're doing it out of necessity because the price of drugs is higher than the price that their cash crops is going to fetch in the market, right? So how do you address that position, that situation responsibly? Well, you don't necessarily say, oh, well, we'll just buy your heroin or whatever. I don't know. I mean, I don't have the answer, but I suspect, my outside of the box thinking is the problem isn't necessarily, accepting the gold and making it a legitimate supply chain. Maybe the problem is more fundamental, like these economies need, these people who are doing this need more sustainable, income revenue we need obviously to address the problems in the economies themselves so that people don't turn to, digging up the gold in the first place. That's a very idealistic take on it, and I appreciate, I'm going to be a realist. This happens no matter what, but I'm not sure if it's very much like, should drugs be, legalized or not? It seems similar. I might be wrong because I haven't really thought about it, but it seems very similar for me.
Okay, thank you. Got another question here. This is a classic. Do you think crypto is a big competitor for gold?
No.
Peter? No. Okay.
No. There we are.
Why?
Next question. No. I mean, crypto had, the debate over the last, increasingly from say 2012, 2013, when Bitcoin actually started to get, above the parapet and become a more visible thing. It's just like gold because it's rare, can't be created at will. It's off-grid compared to national currencies, official currencies. Yeah. Okay. My cat isn't any of those things either. Okay? And you can't inflate his supply because the vets saw to that. Okay? There won't be any more of my cats. Okay? But nobody's trying to use my cat. I mean, seriously, because there is so much difference between gold and crypto. Gold is the most physical of tradable assets.
But they have one thing in common, because I just came back this week from Bitcoin Amsterdam, which is like
the true believers.
No, the big conference. It's like a big conference, and the one thing they both have in common is Nigel Farage, because he was there.
Maybe something else they have in common, Peter, is that governments and central banks can't entirely control their prices.
Well, let me reflect a bit on a survey. The BIS does a survey every other year. We have 135 central banks, which means it's about 93% of the reserves globally are responding to this survey. And we ask all different questions. And over the last few years, we also added a question related to crypto. I'm not talking about central bank-backed digital currencies. I'm talking about crypto. And we check with the central banks what their opinion is and what their expectations are in terms of relevance for their business. And it's no relevance. We ask for questions like, are you investing? Are you planning to investing? Or are you considering at some time? I can tell you that for central bank reserve managers, this is not an issue. And in terms of crypto, I've been at conferences and I heard people talking like, yes, gold is there if you want to protect already and safeguard your wealth. If you are poor the only way to get rich is buying crypto. Well, even that approach didn't work. And we have the figures. In the first year when interest rates are going up, and I showed it on the screen, I didn't really put, but Bitcoin and similar cryptos have been probably the worst performers this year. So I don't think there is really a relevance, at least for the central bank community. And I would say even for private people, it's a place where there is a lot of opportunity again to hide wealth and to
Well,
hide
they say it's much
transactions.
more transparent than other things. And they're
Well, I
very
think there
enthusiasts.
is a discussion between regulators, not necessarily central banks, how to approach it in terms of regulation. And I see a split. There is a group who wants to regulate more from a consumer protection, because there are so many cases of lost or stolen units and tokens. And on the other hand, there is a group of more liberal countries saying, well, let's do them whatever they want, and we are not responsible for if they lose a lot of money. So I think the decision is not uniform on how to regulate. But also here my best guess is that the major jurisdictions will find a way to make sure that if that becomes an issue of financial stability, they would have to act.